Capital budgeting is the cornerstone of financial decision-making in corporations. It's the process by which companies evaluate and select long-term investments that align with their strategic goals. At its core, capital budgeting is about making informed choices that maximize shareholder value. Methods of project evaluation. Three primary methods dominate the landscape of project evaluation: net present value, internal rate of return, and payback period. Each offers a unique perspective on the potential value of an investment. Net present value, or NPV, is often considered the gold standard in capital budgeting. This method calculates the present value of all future cash flows associated with a project, discounted at the company's cost of capital. A positive NPV indicates that the project is expected to add value to the company, while a negative NPV suggests it may destroy value. The internal rate of return, or IRR, is another widely used metric. It represents the discount rate at which the net present value of a project becomes zero. In essence, it's the project's expected rate of return. Companies typically compare the IRR to their required rate of return or hurdle rate to determine if a project is worth pursuing. The payback period, while simpler, still holds value in certain scenarios. It measures the time it takes for a project to recoup its initial investment. While it doesn't account for the time value of money or cash flows beyond the payback period, it provides a quick and intuitive measure of a project's liquidity and risk. Managing project risks and uncertainties. In the realm of capital budgeting, risk and uncertainty are constant companions. The future is inherently unpredictable, and projects that look promising on paper can falter in reality. Effective risk management is, therefore, crucial to successful capital budgeting. One approach to managing risk is through sensitivity analysis. This technique examines how changes in key variables affect a project's NPV, or IRR. By identifying which factors have the most significant impact on a project's viability, companies can focus their risk mitigation efforts more effectively. Scenario analysis takes this concept further by evaluating a project under different sets of assumptions. Typically, companies will consider best case, worst case, and most likely scenarios. This provides a range of possible outcomes and helps decision-makers understand the full spectrum of potential risks and rewards. Monte Carlo simulation is a more sophisticated tool for risk assessment. This technique uses computer modeling to simulate thousands of possible outcomes based on probability distributions of key variables. It provides a more comprehensive view of risk and can help quantify the likelihood of different outcomes. Real options analysis is another powerful tool for managing uncertainty. This approach recognizes that many projects have embedded options, such as the option to expand, delay, or abandon, that can significantly affect their value. By incorporating these options into the evaluation process, companies can make more flexible and robust investment decisions. Capital rationing and portfolio management. In an ideal world, companies would have unlimited resources to pursue all profitable projects. In reality, capital is often constrained, necessitating careful allocation of resources. This is where capital rationing comes into play. Capital rationing involves selecting the optimal mix of projects when capital is limited. The goal is to maximize the overall return on investment within the constraints of available resources. This often involves ranking projects based on their profitability index, the ratio of NPV to initial investment, and selecting projects in descending order until the capital budget is exhausted. However, capital rationing isn't just about maximizing returns. It's also about managing risk at the portfolio level. Just as investors diversify their stock portfolios to reduce risk, companies need to consider how different projects interact and balance each other out. Portfolio management in capital budgeting involves considering the interrelationships between projects. Some projects may be mutually exclusive, meaning only one can be chosen. Others may be complementary, with the value of one project enhancing the value of another. Still, others may be independent, with no significant interactions. By taking a portfolio approach, companies can achieve a balance between high-risk, high-return projects and more stable, predictable investments. This helps to optimize the overall risk-return profile of the company's investment portfolio. Incorporating sustainability into capital budgeting. In recent years, there's been a growing recognition of the need to incorporate sustainability considerations into capital budgeting decisions. This shift reflects both increasing regulatory pressures and changing societal expectations about corporate responsibility. Sustainable capital budgeting involves considering the environmental and social impacts of investment decisions alongside traditional financial metrics. This can involve incorporating the cost of carbon emissions, evaluating potential reputational risks, or assessing the long-term resilience of projects in the face of climate change. One approach to integrating sustainability into capital budgeting is through the use of a shadow price for carbon. This involves assigning a hypothetical cost to carbon emissions in project evaluations, even if there isn't an actual carbon price in the company's operating environment. This helps to future-proof investment decisions against potential carbon pricing regulations. Another technique is the use of environmental, social, and governance (ESG) scorecards in project evaluation. These scorecards assess projects based on a range of sustainability criteria, providing a more holistic view of a project's potential impacts and risks. Some companies are going even further, adopting integrated reporting frameworks that explicitly link financial and non-financial performance. This approach recognizes that sustainability factors can have material financial impacts and should be considered alongside traditional financial metrics in investment decisions. The role of real options in project evaluation. Real options analysis is an advanced technique in capital budgeting that's gaining increasing attention. Unlike traditional NPV analysis, which assumes a fixed path for a project, real options recognize the value of flexibility in decision-making. A real option gives management the right, but not the obligation, to take certain actions in the future. These might include the option to expand a project if it's successful, to abandon it if it's failing, or to delay investment until market conditions improve. One common type of real option is the growth option. This recognizes that an initial investment might open up opportunities for future investments. For example, entering a new market might create options for future expansion that wouldn't otherwise be available. Another important type is the abandonment option. This recognizes the value of being able to cut losses and exit a project if it's not performing as expected. The ability to limit downside risk can significantly enhance the attractiveness of a project. Flexibility options are also crucial in many industries. These might include the ability to switch inputs or outputs in response to changing market conditions. For example, a power plant that can switch between different fuel sources depending on relative prices. Incorporating real options into capital budgeting can lead to significantly different decisions than traditional net present value analysis alone. Projects that might appear marginal based on NPV could become attractive when the value of embedded options is considered. However, real options analysis is not without challenges. Valuing real options often requires sophisticated mathematical models and can be highly sensitive to assumptions. There's also a risk of overvaluing flexibility and underestimating the costs and difficulties of exercising options. Despite these challenges, real options analysis provides a valuable complement to traditional capital budgeting techniques. It encourages a more dynamic and strategic approach to investment decisions, recognizing that value often lies in the ability to adapt to changing